think this is a great way to start off this discussion about the RV, because how are you basing the baseline? Partly it's a US denominated fund, obviously. And when you build RV on a baseline, kind of like RV, a little bit of stat arb in a way as well. Walk me through the thesis, number one. And then number two, I'd like to ask, what is the model showing you, especially in the recent year, that is idiosyncratic in terms of risk and opportunity?
Sure. Yeah, maybe before jumping into that, just a little bit of my own understanding of whole macro hedge fund landscape. So obviously you have a lot of discretionary macro managers. You also have a lot of quantitative macro managers. And this is the class of hedge fund strategies that had great performance recently, as you mentioned earlier. In fact, there were a period post-GFC, the macro strategy went through a period of time of underperformance compared to the other strategies. That was a period characterized by low volatility. As you can imagine, most of the major economies' interest rates were pinned down to close to zero level. You only have these small changes over time to be expressed in the interest rate changes and the currency changes. Of course, all of that changed after COVID. We moved into a totally different regime of higher volatility, higher macro volatility, with underlying growth uncertainty and the volatility of all these countries. So I think that coincided with the great performance you saw recently, the macro strategy. What I see the landscape of macro managers is that a lot of the discretionary portfolio management in the macro space, ultimately, many of the bets are directional bets. So it is really the managers' deep understanding of certain countries and the overall direction, and then they just make a call on the direction and sometimes concentrated bets to generate big returns, like Japan's situation recently.
That's a great example.
Right? And then on the other hand, a lot of the quantitative managers, many managers in the space, can categorize those into trend following strategies, right? These, just by name of it, is really capitalizing on the trends available in the market.
These are technical strategies.
Right? So these are, again, more benefiting from the directional opportunity. Like in 2022, when we have this overall global interest rate going up, a very nice trend, many managers successfully capture that trend, including my strategy as well, and then generate very handsome returns during that time. So I consider those are a very big category of macro managers, capitalizing on the directional opportunities. So relative to that, we also look at these, what I call the relative value opportunities. So these opportunities are like, if you think about it, in the equity space, people are very familiar with it. The equity long-short strategies, you buy some stocks and you short some stocks, and then you hopefully achieve a market-neutral exposure, and then you generate pure alpha without exposure to beta. In FX, in interest rate space, we also have beta. That beta is the dollar move or the global interest rate trend or direction. So the relative value investment in this particular case is also, it's going to be like long short in a country space. That's one kind of relative value, which is the focus of my strategy here, cross-country relative value. There is also a lot of the efforts historically within country fixed income instrument relative value. So for example, you can have these within the US curve, interest rate curve, at different parts of the curve, you can have these bets. You're seeing like dislocations along the curve. And you build a very quantitative model and build a fit of the model, and then rely on the dislocation you see in the market and tend to revert to what they're supposed to be, your fitted curve.
That when you see these inverted yield curves, for example, which are temporary phenomenons for a while.
Yeah, in the long term, long-term pattern, if you establish a very inverted curve, over long term should go back to its normal shape, then there could be a long-term within country relative value bet there. So I characterize my strategy in the space of country relative value. And so there are players in this particular segment, but as standalone funds, particularly focus on this as the main source of alpha is relatively unique, particularly in the Asian market.
Yeah, definitely. Because I've seen some of the other macro managers that we worked with, they express their macro view, not necessarily in rates, but they might express it in, say, ETFs or equities, or even baskets, for example. not to say that they go too deep on the fundamental side, but they might express it in more equities baskets. And what's interesting is that you're sticking very, very, in a way, almost vanilla in terms of its expression in rates and FX, which is where most global macro strategies play in. The RV-centric side of it is something that's unique for emerging managers. Yeah.
Yeah, so I want to say a bit more on that RV versus directional.
Yeah.
I think
and you have both, right? To be fair, your
Yes.
strategy does have both components.
Yes.
I don't want to label it just as
Yeah.
RV because that's
Yes, I do have both, but I have, over the long term, if you look at the average risk taking, majority of the risk taking is from RV. We do have directional risk taking. The approach is like, over long term, we observe within my framework, the Sharpe ratio or risk adjusted return from the directional opportunity is less than RV opportunity, which I will touch a little bit more on a bit later. But there are times that directional opportunity is very good, like 2022. So our approach is that over the long term, average risk taking on directional portfolio is low. But when the opportunity shows up, we tend to embrace it. Why not? Just take what is showing up in front of you. So I wanted to say that the directional opportunity usually is the most exciting. People always talk about it, right? These are large picture, big moves. What is happening in Japan, all these asset classes, these big calls on where the S&P is going to be, where the dollar is going to be. These are super interesting topics people talk all the time. But from a quant's perspective, that directional or market beta is always the most difficult.
Is it noise? It feels almost like on a distribution model, it's noise, right? Meaning you could take advantage of it. But that's a discretionary approach.
Yeah, if the efficient market hypothesis has any chance to work, right? Yeah. These should be the markets that give you the efficient market,
right?
Because so many market participants paying so much attention to these markets. Right. Any new information, in theory, should immediately be reflected in prices. Yeah. Right? There definitely will be kind of genius strategies that can predict the S&P in a very successful manner, and these people can make a lot of money on just trading S&P, because then you have very good liquidity and you don't need to worry about anything else. That you can just do that all day. Yeah. You can build a very large fund for that. But from a quant's perspective, that is the most difficult thing to do. It's inherently difficult to predict the direction of the market. It's difficult to predict beta. It's because the data is just simply limited. Yeah. We only have a single history, non-repeatable history. And everyone is looking at it. It's supposed to be most efficient market there. RV, on the other hand, is kind of orthogonal to the directional view, right? RV is supposed to be, if you remove the directional view, what's left in these relationships, a little bit more complex and more nuanced relationships across the different assets of countries, right? If you look at that, then it is not the most discussed, most talked about development in the market. Less tension is put on those relative patterns existing in the market. In theory, it should be easier to predict, and there should be more alpha available in that RV space. And if you have a proper way, a quantitative method, a methodology to be able to clearly separate those and use historical data to find empirical evidence, you indeed find that, in our case, that the RV opportunity is much greater than the directional opportunity. And that's why we focus so much more on RV risk-taking versus directional risk-taking. Think about it in our, for example, EMFX strategy. We have close to 20 currencies, 20 very different countries at different stage of development, facing all kinds of idiosyncratic developments. Yeah. All of that presents you a very rich, kind of divergent picture across countries, which is the relative alpha opportunity in front of you. So in our actual analysis of the empirical data, we see that even considering the higher transaction costs in emerging markets, the relative value opportunity there indeed far surpass the other markets we see, partly because larger number of countries, and then what I mentioned, very different stage of develop in the very different countries.
So give us an example, right? Because this is really interesting, especially if we look at EM, which is, partly it's very sexy for investors who are looking at who've historically been, already well padded on the vanilla strategies. So the prospect of capitalizing on dispersion or spread type of opportunities in emerging markets, especially how they correlate with each other and the covariance with each other, is something that's quite interesting. Do you see, and I would imagine certain events, policies, and macro narratives do express themselves in the indicators. Can you give me a couple of examples in the last couple of years where you've seen those narratives express themselves, in particular in the EM market?
Sure, yeah. A lot of in our approach that we do look at both fundamental variables and shorter-term price-based variables. So that some of these fundamental variables are long-lasting impact or effects you observe in the marketplace, which are well documented in the finance literature. So for example, we always look at the balance of payment dynamics of different countries, the current accounts, foreign direct investment. These kind of variables, they don't change really that much over months, over quarters. If you build a portfolio just based on these variables, it's going to be a very static portfolio. No trading at all. You just have your positions sitting there very long term. Of course, the drawdown behavior might be a different story given the volatile nature of the FX market. But in our approach, if you use those variables in a proper way, in many cases or in a relative value way, they do provide long-term risk-adjusted return, pretty decent long-term risk-adjusted return. So we do use them as a kind of serve as a baseline of our portfolio. On top of that, we add on these more fast-moving price-based signals. There's all kinds of prices, spot prices, forward prices, option prices, CDS, credit default swap prices. These prices would potentially just capture the market participant sentiment, all kinds of shorter-term dislocations, supply and demand imbalances, all of that. Yeah, so you asked about in the past few years, any such signals that capture the big idiosyncratic.
Yeah, look at a narrative, for example. Let's take Russian war, for example, and the ruble. Of course, that hits print. Moment it hits print, right? Then everyone's thinking, okay, peso situation, right?
Yeah,
the peso problem, which is coined from, for those of us who are new to this field, it's from the 70s. It was based on peso devaluation, which hit a lot of financial instruments. A lot of them were mispriced because they were not stress tests for certain situations like this. And there's a lot of unwinding as a result. The peso problem is something that is persistent with quantitative models, and it's still something that developers need to think very, very clearly about. But yeah, please go. What are your thoughts there?
Yeah, it's another kind of example of exactly that peso problem. There's these hidden risk that is, you don't normally see it, and it will just disguise itself. So before the tail event actually realizes, you would see the return pattern on some assets or some strategies to be a very high Sharpe ratio kind of pattern. But the reality is that the risk is being suppressed in some artificial manner, just like the US Swiss franc situation, right? And then
explain how is it suppressed in both of these examples?
Because there is this hidden risk that you, just like the peso problem, eventually there's a huge devaluation on the currency. But before it happens, it's unknown to people. I mean, maybe it's known to some
policymakers.
Some people, some practitioners, they know this is going to happen someday. This is a hidden risk. But the hidden risk is not always priced properly in the market, and many of the market participants might overlook that hidden risk. So before the risk actually realizes itself, nobody is certain like when it's going to happen, whether or not you're going to see that happening in your lifetime. So if you don't
it's like the 2009 crash, right? The property crash in the US. There were indicators, the short book, from even the Big Short movie, right? Or not the movie, but the actual Big Short with Michael Burry. He actually started that position 3 years ahead of the incident. And so first thing that comes to my mind, the market can stay irrational longer than you can stay solvent. And so you have this buildup of pressure as a result, and you don't know how long that pressure will build.
And before that realized risk, it's such a beautiful trade. Mexican peso trade was such a great trade because you just constantly make money
Yeah.
until it blows up,
Yeah.
right? So you actually see a lot of examples in the financial markets in different contexts like that. This is always the super difficult thing to properly reflect this hidden risk in your portfolio positioning. It's really difficult to do.